Thanks for joining us for this next video. This one is from Chapter 2 on journal entries. Let's take a look at the problem. The following transactions occurred during March year 1 for the Player Corporation. The company owns and operates a wholesale warehouse. So you see we have 9 transactions here that we're going to record journal entries for. So I'm not going to read through each one right here. You'll see each one separately on the following screens. Okay. This first transaction tells us that the corporation issued 32,500 shares of common stock in exchange for $325,000 in cash. So let's look at this first journal entry that we have to record through the accounting equation of assets equal liabilities plus stockholders' equity. In the problem, we have common stock and cash as our two accounts. Common stock is an equity account. Cash is an asset account. So what we're saying is there's an exchange of $325,000. So the corporation receives that amount in cash. So assets go up by this amount. Common stock increases with a credit, so it also goes up $325,000 as well. Thus, the equation stays in balance. So as a journal entry, we will have cash debited for $325,000. Remember, assets increase with a debit. And then we have common stock, which will be increased $325,000 as a credit. And liability and equity accounts always increase with a credit. So we see where it says under account title, it also says explanation. So this could be a potential journal entry where you might need to provide an explanation in terms of how much each share cost. So to figure that out, you would simply take the $325,000 divided by 32,500 shares. That gives you $10 per share. So you would simply put in parentheses 32,500 shares at $10 a share. Moving on to the second transaction, the company purchased equipment at a cost of $36,000. $12,100 cash was paid. A note payable was signed for the balance owed. So just by recording the first two parts of the journal entry here, the equipment at cost and the cash paid, we can take the difference and that will tell us the balance owed and thus what we will record as a note payable. So we know the equipment cost $36,000 and we will record it at cost. It's an increase because it's an asset account. Equipment, $36,000. We paid out cash, which will decrease that account, $12,100. The difference, $36,000 less the cash we paid, gets us to $23,900, and that will be our note payable. And a note payable is a liability, so it also increases with a credit. Number 3, the company purchased inventory on account at a cost of $97,000. The company uses the perpetual inventory system. There's 2 inventory systems. They are perpetual and periodic. Perpetual means that they update their inventory account continuously, whereas the inventory used under the periodic method does it in periods, and they record their inventory in journal entries as purchases instead of inventory. So with the perpetual, we'll be using the merchandise inventory account. So to record the journal entry, we know that we purchased inventory, so we're going to record merchandise inventory, $97,000 to increase it. We purchased it on account here, according to the problem, so we will credit accounts payable for $97,000. We can look at that on the equation as well. Assets equal liabilities plus stockholders' equity. Inventory here, our asset, goes up $97,000. Our liability accounts payable goes up $97,000. So we still equal. Number 4, the company had credit sales for the month totaled $150,000. The cost of goods sold was $75,445. With this transaction, we have to make 2 separate journal entries. One is here for the credit sales from our inventory we sold, and then we have to also make a journal entry for the cost of the inventory that we sold as well to decrease the account. So we start with the sales. The sales were made on account. So that tells us we need to debit accounts receivable for the $150,000. we credit sales revenue on the other end. A credit to revenue increases this account. And then we record the next transaction, cost of goods sold, at the $75,445. That's an expense. Then we credit inventory, which will decrease that account to $75,445. One reason that we use cost of goods sold as an account is because it shows us how much we paid for the inventory, and then we could see through revenue how much we sold it for. So the difference, if you think about the income statement, we take sales revenue minus our expenses, such as cost of goods sold. We can see what our income is from that. Number 5, the company paid $4,400 in rent on the warehouse building for the month of March. So it's the end of March, we have to record the rent expense. It's a very simple transaction. We debit rent expense for $4,400 because we've incurred that expense for the month. And then we paid cash, so we credit cash to decrease that account, $4,400. Number 6, the company paid $5,100 to an insurance company for fire and liability insurance for a 1-year period beginning April 1st, year 1. What's important to note here is this right here, that it began in April 1st. So we've paid for the insurance, but we haven't incurred the expense yet because we haven't been able to use it, because remember, all these transactions are made in March. So therefore, this insurance policy, we prepaid for it. And as a recap, or a review rather, prepayments are assets. For example, prepaid insurance or prepaid rent. So our journal entry here will be to prepaid insurance, which increases that asset account, and then it's a credit to cash, because whenever we pay cash out, a credit decreases that account. Number 7, the company paid $75,000 on account for the merchandise purchased in 3. So let's look down here again at our transaction from number 3 here in the pink box. Inventory was debited for $97,000. Accounts payable credited $97,000 from where we purchased inventory. So now all we're saying is we started with accounts payable $97,000, and now we've paid cash to decrease that account by $75,000. So that transaction will be a debit to accounts payable, as that T account shows. And then we will credit the cash for the cash we paid out to decrease that account. Again, that's like an example of paying off a credit card. Number 8, the company collected $68,750 from customers on account. So it doesn't necessarily say this, but this could have been from our transaction in number 4 over here in the pink box where we had our sales revenue and accounts receivable, or it could be from some other sales that customers had paid on credit for. So nonetheless, all we have to do is put a debit to cash for the cash we've now collected, $68,750, and then we will credit accounts receivable to decrease that account. Number 9, our final transaction. The company recorded depreciation expense of $1,100 for the month on equipment. So, when we record depreciation, the debited account is depreciation expense, and we credit accumulated depreciation. And accumulated depreciation, as a review, is a contra asset account. So if you debit accumulated depreciation, you're actually decreasing the account. You have to credit it to increase it. And basically what that means, a contra asset account, is it decreases our total assets. So how we record this is a debit to depreciation expense for the current depreciation of $1,100. and then we credit accumulated depreciation, and we also indicate what asset we are depreciating, which in this case is equipment, and we credit $1,100. And those are your 9 transactions.